Hi guys, how are you? Welcome back to Real Macroeconomics and Investing. Welcome to YouTube, um, TradingView, Twitter, my subs, everybody. How you guys doing? I hope everybody's having a great summer after all this COVID nonsense. Anyway, so let's get started. Summer is almost over. We're going to see what the market really wants to do come September, October. It's going to be fun. So just kind of recap here a little bit. You guys know the way I look at markets, right? It's different to say the least. I don't do the traditional stuff. I do my bare knuckle charting, which is basically analyzing bare knuckle, bare charts, right? It's just price. That's it. It's all I care about. I also contrast that with macroeconomic understanding. So you got to understand macroeconomics, where we are, what's going on. Um, and when you take those two and contrast them and try to figure out where the key areas are, what's the direction of the economy, what's the direction of the stock market, see if they're jiving, you get to pick really nice risk reward areas. It's not just willy nilly going out and buying and selling and not knowing exactly where you should be doing that. So this is what you guys would see, and this is what I see. All right. Obviously, very different than most people. So getting back to this crypto, we'll start with crypto. What you saw was 1, 2, 3 down. Everybody was very bearish. No one was looking at this falling wedge. And then I said buy below, 18.5, whatever it was. And then it took off, right? And off we went into space again, which was great. At some point, though, it started to get a little bit um, bearish looking. All right, you had a rising wedge. That rising wedge was showing you a nice big bear flag. And then I said, well, you got to get out. Done. It's over. And I said that mostly on Twitter. Um, and I'm not sure if I'm supposed to say that or not, or whatever. Um, so where are we now? What's going on? So I said get out somewhere in here, right? I think it was somewhere in here. I'm not exactly sure where it was, but it was a few weeks ago. So here's where we are now. 1, 2, 3 down. Okay, 1, 2, 3 down. Wherever this ends, I don't know where it's going to end, but it's broken this bigger structure. So how do I look at this chart? Well, it's very simple, right? You had a wave one, a wave two, a wave three. And don't say this is Elliott wave. It's not. Okay, you got the hook. We got the structure. Which way is the structure pointing? It's pointing up. That's great. What do you think is going to happen next? That's right. Okay, price is going to go down, and that's exactly what it did. So look for more downside. If you look at this little piece right in there, see that little bear flag? Boom, that broke. Now the problem with that is that if you look at the bigger picture, right? What's it do? Right? It's got a bear flag, break. Right? Little wedge flag, break. Bear flag, break. Okay, that's what a bear market does. Right? That's the way it works. Now let me show you what I posted. This, by the way, this is the remake of this video. I can't remove it for some reason. It's not playing, so it's basically the same video. So I posted Solana, all right, as a bear setup, and here it is. It's a very simple chart, all right? It's a big thrust down move. You have your 1, 2, 3, it hooked. You have the structure. Structure is pointing up. What do you think the next move is going to be? More likely than not to the downside. Well, let's see what happened. Obviously, it was right. Good. So that's the way bare knuckle charting works. Now, is it just the bare knuckle charting? No. It's also the macroeconomic understanding. You got to understand macroeconomics. You got to understand what environment we're in. Very important. I won't talk too much about it, but you really have to get on board with that. So cryptos right now are in danger of a big thrust move to the downside. Doesn't mean it will. Doesn't mean it will happen today, tomorrow, the next day, or whatever. But we are at that position right now. So keep that in mind. If you take a look at the dollar, dollar is again pushing higher, rightfully so, as per economic understanding. We are right at on the verge of just making new highs right in here. See it? 109.19. Okay. Why is that? Well, we're raising interest rates. And the Fed meetings, usually I don't talk about, nor do I care about what they're going to say, because I generally know what they're going to say. What I liked about what what Powell said was that he finally became decisive. Okay, he says, "Look, we're going to deal with inflation. That's it. Period. End of story." Now, is he going to stick to those words? You gotta believe he will. As such, that means interest rates are going higher. That means that the dollar is going to strengthen, which means it's going to be bad for uh, a number of things, which we won't get into now. So let's continue with the overall market. Okay, so what's going on in the markets? Well, what's going on is what I've been telling you for a long time. Don't try to pick bottoms. Now, hopefully, you guys figured out what that means and why I said it. And I said that all the way back here. Don't try to pick bottoms. And the reason you don't try to pick bottoms is because we're not ready for a bottom. And you had several bear market rallies, which everybody gets so excited about. They're there to provoke emotion, and then they fail. And I have a number of videos talking about it. Okay, the market, got what it wants and then doesn't like it. Right? Then they get another one, and guess what? They don't like it either. So we're not there yet. We're not. It's not ready for a bottom. If you are looking in charts for a bottom, you're not going to find them in the charts. You're going to find it in the macroeconomics, not in here. All right. Usually, you could use the charts in the past few decades. Not this time. It's different this time. Now, let me show you a couple of things. Let's go back in time. Let's go back to January 2021. Okay. And I said, don't try to pick bottoms. Right. I started back then telling you, don't try to. Nobody even knew we were going to go into a bear market. But fortunately for me, I was right. Um, I've been wrong many times before that, so don't think I'm always right. Okay. Shorting is not the opposite of buying. Okay. I have this video. Make sure you guys go back and look at that. The crowd gets what he wants, which was this little pop right here. Okay. The crowd gets what he wants, but now they don't like it. And that what happened? Of course, the markets went lower. Just to kind of give you an idea of what higher interest rate means, right? If you look at junk bonds, they're selling off like crazy. And I said, look, this is a key break. And this was back in February 4th of this year. Again, I'm a macro trader. I'm not going to tell you buy today, sell tomorrow, buy again. I'm a macro trader. So my trades last much longer than everybody else's. Uh, so look what's happened to junk bonds. They've sold off like crazy. What do you think that's going to do to zombie companies, right? The borrowing costs are going to rise, especially when they're on the verge of bankruptcy. So this is bad. But bad does not mean we're going into a recession. We're still in an inflationary environment with low growth, right? Low to flat growth. So I would say we are in stagflation. So a lot of people disagree with me, but whatever. We talked about new home prices. Okay, you got the first indication all the way back in February 5th. Nobody was looking at anything going wrong with housing back then. And I also overlaid the stock market. Housing goes, stock market is going to go. They're both going to go together. And in this particular case, I ended up being right as well. Okay, housing is on the way, and this is new home prices are going to be on the way down. Okay, stock market is on the way down. So again, way ahead, and that's usually what happens with macroeconomics. You're way ahead. This is the chart I wanted to show you. It's different this time. Not this time. That's what I said right here. Not this time. Very important. It's different. It's not like the previous ones where you could just kind of, pop up, pop up, pop up. Pop. It's not the same. It's different this time. So take a look at it. Right? See? It's kind of settling in there. So again, this is the NASDAQ 100. The number of stocks above the 200-day moving average. It's about 28% of them. 28%. Not the same. So keep that in mind. We have a rule here as well that if you're going to break the top, you're going to break the bottom. From failed moves, they're going to come fast moves in the opposite direction. That's what's happened. That's also bare knuckle charting. Okay, so look at the gap down for today. All right, look at that. We're down what 4% on Friday and another 1.25% today. Okay, that makes a lot of sense. Why? Because money chases yield. Okay, so if the Fed is going to raise interest rates, it has to sell off bonds. Bonds really didn't do a whole hell of a lot because bonds are more economically savvy than stock traders are. So look at the stock market. The stock market has to adjust. It has to adjust for higher interest rates, and it's doing that right now as we speak. So that's it for this video. I won't get too technical into stuff, but thank you very much once again. Be really careful out there. Don't fall in love with the upside. A lot of caution. Okay, be cautious. And I'll talk to you guys soon. Take care. Bye bye.